Hello and welcome to Property Mastermind Podcast, episode 191. Today we are talking creative financial strategies for developers. A great episode where we unpack the different ways that you can structure deals with your money, with other people's money, where everyone's a winner. And it will open your eyes up to potentially getting started in property development earlier than you think you may have, and understanding how finance really works. A great, very interesting episode. Bob's going to keep it really simple. Let's jump on in. Hello and welcome to episode 191, Creative Financial Strategies for Developers. Crikey, Bob, let's tell the truth. How many takes did I have to do to get that right?
A couple.
I think I did about 5. I was like, episode 100, I couldn't get the words out.
No. Well, there's a cyclone building outside, and I think you had one eye on the cyclone.
I don't know what's going on. Oh my goodness, that was horrific. But anyway, we've made it. We're in. And to be honest, this is a whole second take of a podcast, so let's just not even talk about it. Before we get started, I'll just make sure we're all in check. Bob, what's your tip for the week?
Based on that, I think maybe get it right the first time, because it is our second one, and we had quite a few takes. And we tossed around, the sound wasn't just perfect, and in the end we thought, no, we've just got to do it again. And so here we are. Hopefully this is much better than the first one.
Crikey. Oh my goodness. And if we relate that to property development, sometimes things are just not going right and you need to double check, and we probably didn't double check enough.
No, but we will next time.
Yeah, we're on a redo. Here we go. It's looking good already.
I'll blame the cyclone.
Yeah, we'll blame the cyclone. Giving away the book, Property Millionaires Exposed to Peter Aquilina. Peter, this is in the post to you. Thank you. He sent an email saying, really enjoying the podcast. So I hope you get a bit out of today. Looking forward to perhaps seeing you join the community. That would be great. Anyway, Bob, today we're talking creative financial strategies. And we want to keep it really simple so people can understand them. But it's such an exciting topic. And I had a phone call this afternoon from a past mentoring student who's about to jump in as to being a current mentoring student again, Carla, and she's found a site. And I said, so, how's it going to look moving forward financially? She said, well, I'll need an investor. And I said, will it be an equity or money partner? And she goes, well, I'm going to model them both out and see. And I loved hearing that. The fact that she has the opportunity to model it out and see which works for her, but also which works for an investor. And she knows whichever way she goes, and whether she brings that finance in early or later. It was a great chat. Anyway, I'm so excited for her. Good to hear women jumping on board and doing more property developments. So
yeah, love it. And Carla's going to go great.
Oh yeah, she's fantastic. Anyways, that's Carla's wee plug. Anyone looking to invest in a project over in WA, Carla's looking for money. Okay, Bob, let's unpack financial strategies for developers. I just first want you to explain the difference between debt and equity when it comes to financing. You know how you've got debt, you've got equity, and you're looking for finance. Let's just explain that for people in really simple terms. Yeah,
well, most people understand finance, say, for buying a house or buying an investment property. Two things. You need a deposit, and then we'll say the bank in this case, the bank lends the rest of the money. That's pretty normal. Of course, you have to prove serviceability. You have to prove that you can pay the interest every month. But aside from that, it's a deposit and a loan, isn't it? When we talk about property development, we tend to use the word equity rather than a deposit. Equity really means the money that you put in, and the debt is the money that the financier puts in. So on a typical example, you put in some equity, financier puts in some debt by way of a loan. If you add up the two, the equity and the debt, it will equal your total costs. Because that's what you want. You want enough money to do the project. You want enough money to cover your costs, and that's made up of equity from you, usually. Well, equity anyway. Equity from someone, shall I say, and debt from the financier.
And Bob, so we've got equity and debt when it comes to each. Are there any pros and cons? And it's a great way. It's like, do you use your own money? Do you use the bank's money? What are the pros and cons of using more equity or using more debt?
Well, most people, when they develop, they go to the maximum loan-to-value ratio that's being offered, because the less money you have to put in my opinion, the better. Look, if you had a lot of money, you could finance the whole project yourself. And that's fine. You wouldn't have to go to a financier. The return on your capital would be good, but if you leverage your money by putting in some yourself and some from a financier, the return on your capital goes up quite a lot. So the less money you put in and the more money the financier puts in, the higher the return you get on your capital.
Which also means the other capital you have left could be doing something else?
Yeah, well, if you got more than enough, you could be putting that into another project. So, yeah, debt and equity, that's what it adds up to with property development, because the financing is a bit different from buying your own home.
Yeah, so just looking at, and now that you've brought up buying your own home, traditional bank loans, what do banks look for when it comes to property development? And here we go, because this is where a lot of people, especially if you're new to listening to us, you're going to have a whole, what? I didn't know that moment. Talk us through that, Bob.
Yeah, well, when it comes to property development, the normal banks that you're used to dealing with, the big four and some of the second-tier banks that you would use if you bought your house or bought an investment property, typically they don't like financing property development, certainly not at the interest rate where they finance houses. So if you think about a normal bank, let's talk about banks. They make their money by lending at a low interest rate for a long period of time. They like 20, 30-year loans. And so they're prepared to do that. That's how they make their money in the long term. They don't make much money if they're lending at those low normal retail rates for, 12, 18, 24 months. They don't just get the return. So they really don't like lending on property developments. There is a commercial arm, what they call a commercial arm of while we're still talking about banks, that does handle property development. And also commercial investment purchases, you want to buy a small shopping centre, industrial units, those sorts of things. The commercial arm of a bank could be the financier for that. And they do finance property developments. But these days, banks that finance property developments, they're really looking for two things. People with a lot of experience, and ideally people they've done business with previously, and large projects. A lot of the banks won't touch projects where the sale price of the project is under $10 million. So that really knocks out most small developers. The good news is you don't just have to rely on banks.
And most people that ask people like yourselves, we aren't doing deals that are $10 million, well, some are, but most people, that, most 99% of our community are doing deals that are just the first, either a duplex or just a simple subdivision. So that's why they will generally just go to commercial finance. So Bob, how does somebody find a commercial finance broker?
Well, considering the banks, the retail banks that you're used to, they're not going to be much help at all. The commercial banks, well, they're not going to be any help at all either. So we go to what we call non-banks. And these days, I'd say at least 80%, maybe even higher, of property development projects are financed by non-banks. And they're a type of lender, but they're not under the banking system. They're under a different system, the non-banks, and they're happy to lend on property developments, but there's a few differences between them and the banks, of course.
What are the differences?
Well, they're more expensive than bank interest. Their application fees are higher, their interest rates are higher. There's some advantages as well that often with banks, particularly when you get into slightly larger projects, they want you to have a certain number of pre-sales before they lend you any money to do the construction, whereas the non-banks don't. Non-banks tend to lend more money as well. They'll lend more money than a bank would if they did it. And so, yeah, sure, you pay a bit more for your money, but you get more money from the bank, which means you put in less.
You get more money from a
non-bank,
From non-bank, yeah.
Yep.
From commercial finance.
Yeah. So I'm just talking about banks and non-banks.
Oh, yeah, banks and non-banks. Okay, sorry.
At the moment.
Yep.
So, the non-bank will lend you more than a bank would. It's a bit more expensive, the money. Typically, you don't need pre-sales. So there's, pros and cons. But the bottom line is you're probably not going to get any money off a bank anyway to do a property development these days. So the non-banks, and there's lots and lots of non-banks out there. They've been growing for years. More and more non-banks come on the market looking for that cut of the action that the banks didn't have. I can remember in times gone by, I'd say 80% of property developments were done by banks, financed by banks, and now it's the other way around. It's the non-banks that have stepped in there.
What's the reason for that, Bob?
Well, it's a vacuum because when the banks stop lending, the opportunities then happen for the non-banks. The non-banks need to charge more because they get their money from well, often from people with debentures or from super funds. They get their money from a lot of sources where they have to pay a higher interest than the interest that banks pay depositors. And so they have to
What do banks even pay people these days? I wouldn't even know.
I don't know, high fours probably as we speak, but
Why
yeah.
would you?
Well, why would you?
Why would you?
It's probably why we don't. Yeah. So that's the difference. Look, higher interest rates, higher application fees, but they'll lend you more money. And the other thing is they don't look too hard at you. I mean, they do to a degree. What I mean by that is, a bank will tip you upside down, shake you, see what falls out of your pockets. They want more equity from you. They want, lots of, all your tax returns. They want spare capital to one side. They're tough to do business with banks, if you can. Most people won't anyway. But the non-banks, they'll, as I said, they'll lend you more money, and even credit impaired people, with good property development. The non-banks are what we call asset lenders, so they lend against the asset. They look at the deal, and sure, they're looking at the borrower, but not. They don't put the borrower under the microscope like banks do.
Oh, so that when you say they look at the deal, that just shows the importance of having a really good feasibility, putting together something that looks fantastic. I mean, it's going to be checked by a valuer anyway, but just really being professional. So when you're presenting something, it makes that deal look fabulous, especially if you know it is.
Yeah, so that's how non-banks compare to banks, and really most of the time you don't have a choice. The other thing is, and we haven't mentioned, that's called commercial finance. We didn't mention the term earlier, I think.
Oh, I snuck it in and you
did.
woed me back. You're like, woe back, cowboy.
I was on a roll.
Yes.
I was talking about banks and non-banks.
Yes.
The big difference between retail finance and commercial finance is, with retail finance, as you know from buying your own home, serviceability is a big thing. You have to prove that you can pay the interest every month. With commercial finance, they actually give you the interest to pay them every month. It's called capitalised interest.
How good's that?
Yeah,
Get a loan, and then and you've got to pay them back, and they give you the money to pay them back.
So it's part of the loan. They actually lend you the interest component of your development.
So right now, there's like pennies dropping all over Australia. People are thinking, what?
Well, that makes a big difference, because how many people have you spoken to who are inquiring about property development and think, I can't do it because I don't have serviceability?
Makes
and
no
what's
difference.
your answer?
You don't need serviceability.
No. You've got to use commercial finance. Commercial finance, most likely non-bank, and it'll be covered. The interest is covered in the loan. So that's a huge difference.
But what about when, and even though this is take two, it's completely different to take one, and I'm going to start asking different questions. What about when somebody is perhaps retired and they've got equity in their property, using that equity, say maybe you're listening to this and you're like, Mum and Dad are retired. They own their house outright. That's an absolute waste of money. I could use the equity in their property to start my first development, or do my first development, or do a development. How did those people access it how does that work?
Well, if they had an unencumbered property, it wouldn't be easy to pull equity out of it in the normal way, where you would have to prove serviceability. Pull equity out through a retail financier, you've got to prove serviceability. It's not going to happen. If it was unencumbered, you could actually put the title up, or they could offer the title to be put up.
To a commercial financier?
Yeah. Look, some financiers are probably a little bit funny about an older couple putting their house up, the title on their house, to fund somebody else's project. But that's only because of their age. But some would. They're really just looking at the pure numbers. And so to put a property up, an unencumbered property up as...
Unencumbered means it's debt-free, just in case you don't know.
Put up a debt-free property into a property development project, the cash equivalent is about 70%. So if it was a property worth $1 million that had no debt, that's the equivalent of putting in $700,000 cash.
Stop. Where in Australia is a house worth $1 million?
Good point.
Yeah.
I wanted to use a nice round number.
It's right, $2 million.
So, that's one of your lefties out of left field.
Yeah. Yes, I just thought it's one of those things that I could see people wondering about, or they may have a friend, or, maybe not parents, who knows, but it's something that, it opens the door, doesn't it?
Yeah, it does. And so what it really boils down to is, quick recap, non-banks are going to be probably your financier of choice. There's some advantages and some disadvantages, but look, the bit extra that you pay in the interest and the application fees, if they're going to give you the money and you can get it with putting in less money, and they don't need to pre-sale. It's got to be a good thing anyway. So yeah, that's it in a nutshell.
But we've got to unpack something else yet.
I know. What is it?
Well, we haven't talked about using other people's money. Like you talked about using somebody else's equity in their property if they own, or whatever they had in their business, whatever, maybe they own something. But what if, let's go to Carla's example. That's a great example, actually. She wants to do, she's found a deal that works, so she's going to look for and my question is as a loan partner or an equity partner. Bob, just explain the difference between a loan and equity partner.
I'll take one step back. We know now that financiers need equity and they'll lend you the money. They'll lend you most of the money. As a rough indication, you need to come up with about 25 to 30% of your costs. Whatever it costs you to do that project. Somewhere around 25%, with a lot of non-banks, you'll have to come up with that money. The question is, where do you come up with it? And if you don't have it, then somebody else can come up with it. And that's what you're talking about. And that's what we often call a joint venture partner, but we like to give it a bit of a definition because there's a couple of ways, in fact, there's many ways of doing these types of deals.
We did 2 full days on it last year.
We did.
And we do them all the time. And we just call them strategies ourselves. We're looking at something else right now, and the conversation that I had with Bob this morning was, so Bob, what strategy are we going to use here? Like, what way will we structure this? Well, because sometimes it could be equity partners as well as loan partners, or they could come in at the beginning or a bit later. There are so many different ways to do it, and it's very exciting.
Yeah, and you can even have a combination of the two.
So, yes.
So this is the terminology we use. Let's just say you need to do a project, and let's just say you need $500,000 equity. Okay, financier's going to lend you hypothetically $1.5 million. You have to put in $500,000. That'll give you $2 million. You can do the project. Let's just say they're the numbers. Well, the point is let's say you don't have the $500,000. But you've got an investor who has $500,000 who would like to get their money working for them. They want more than the 4.8% they're getting at the bank or whatever it is at the time, and so how does that work? Well, one of our models is what we call an equity partner. Now, with an equity partner, that investor would become part of the project. They most likely would be part of the ownership structure. So jointly with the developer and the investor, they would jointly own the property. And so that's solid, that's ownership, that's really, really strong security. They would both then borrow the money from the financier to do the development. Normally one of the parties, the developer party, would do all the work. And at the end, when they sell everything and make a profit, they would split that profit. So that's a profit share thing. There's no absolute rule on how much that is, but if we kept it really simple, let's just say they share the profit at the end. So the equity partner is part of the deal, and the reward they normally get is profit share. Let's just say you've got an investor, once again, with $500,000, but they don't want to be part of the project.
What would be their reason for not wanting to be part of the project?
Well, if you're part of the project, you're also part of the development finance. And they might not want to be part of the development finance. They might just want to, they're happy to, if you like, lend the $500,000 to the developer to put into the project. They just don't want to be in it. They don't want to be on title. They don't want the to be on the property development loan. Well, that's fine. They can be what we call a loan partner. So they simply lend the money to the developer, and then the developer puts that money into the deal. What's different about this is it's just a loan.
And they get an interest rate return better than the 4.8% at the bank or whatever they're paying.
And that's what it is. A loan, in this case it is a loan, they're lending the money. There's a loan document. You get interest on a loan. You make a loan to somebody, you get interest. And that's what they get. They get an interest rate return on their money. They typically don't get profit share. Normally in the finance world, equity produces profit share and a loan produces an interest rate.
Now, I have to tell you, and I came clean on last night's take one of this podcast, I used to struggle remembering the difference between the two. So for me to remember, I used to think Joan gives me a loan. And so it would always be, because sometimes in different communities or when you're talking to people, they talk about money partners, and I used to just get confused. So for me to remember, I used to say Joan will loan the money. And so Joan loans, she gets an interest rate return. Equity partners get a share in the profit. That was my way. So if you do struggle, just remember Joan. She loans. She loans the money.
Yeah. The term money partner really is, well, yeah, sure, there's a partner lending money, but that doesn't really describe what it is. That's why we like to split that up and say, what are they, an equity partner? Are they in the deal? Do they get profit share? Or are they a loan partner who simply lends money externally to the project and gets an interest rate return? So that's how we like. But there's so many ways of cutting it. And look, you can even do a project that has both.
I was just going to say, what about somebody who wants to be an equity partner? So they are putting money in, but sometimes they're loaning a little bit extra money and they get a return on their money as well. That doesn't happen too often, but it can't it?
Well, it could be a totally different person too.
Yes, yeah.
You could have an equity partner, you come in, buy the site, get everything going, get the approvals, come to the construction stage. At this point, you need a bit more money to go in. That could be a loan partner now. And so that's an example, again, and there's plenty of different ways of cutting that, of having an equity partner and a loan partner in the same deal, two different people here.
And this is absolutely so normal. You might be thinking, oh, it sounds confusing. It is so done every day. It's probably, it happens just most property developments, really. How many people do you know just do their own without having some sort of loan or equity
lots.
partner?
We tend to attract those people as well.
Yeah, I suppose.
I was the first person to really get out there and start teaching creative strategies, and that was in 1989.
Oh, right. Okay,
So,
gotcha.
Yeah, and I did a little book once. I had 13 different types of creative strategies. There's a few there, but because I've always taught it, because we use it, a lot of the people in our community that we teach use it, and let the world copy what we do.
So if you're interested in learning about the difference or how that might work, Bob did write a wee ebook. So if you want a copy of that, you can just reach out to me and I can send you a free copy. It's just an ebook. It's simple. He's made it so from the investor point of view. So when you read it, you know what that investor wants to find out about. So it's really interesting and simple to understand, breaks down how it works. Yeah, so that's a great book to get a copy of. Bob, the last thing that I really want to talk about, or actually no, not the last. Talk about vendor finance. Explain how vendor finance works, which is another creative strategy.
Well, it is another creative strategy. In fact, the very first property development project I ever did was a vendor finance deal. And I didn't call it that because I really didn't know what it was or how to do it. I was taught by the vendor. How's that? Now, that's a story for another day, but that's a great story.
I think you've told it on this podcast.
Yeah, probably have. But look, it's different from the equity partner thing. What happens in a vendor finance deal is you have somebody wanting to sell their property, and you, the developer, purchase the property off them, so the title gets exchanged from them to you, but you don't pay them all the money yet. You pay them a percentage of the money now, and then you owe them the rest of the money, plus an interest rate return, and you pay that later. That's a typical vendor finance deal. And when I say some pay them some now and some later, there's no absolute as to what that is. It could be 50%, it could be 25 now, 75 later. It even could be, 75 now and 25 later. What it means is this, that you take ownership of the property, and so you can use the equity in that property for finance, but you've only paid, let's say you paid for half it. So you get the equity value of the whole project for only having paid for half it.
Oh, I've got a question here, Bob. So does the financier, so then you might go and get some commercial finance for construction. Does the financier have to know that you have vendor finance? Because
because you own it.
Right.
You settle
so
on
that's
it.
a private deal that a financier doesn't even know about.
Well, they don't need to know about it. It's got absolutely nothing to do with getting the construction finance later. So once you take possession of that site, let's say you pay for half it now, you're going to pay for the other half later plus some interest. Then you can do what you normally do. You can borrow against that. You can, because you own it, it's yours. You can borrow against it, and then you go ahead, get your approvals, and eventually get your construction finance, and develop it, and then sell it, and then the financier that gave you the money for the development, they're the first mortgagee. They'll get their money, and then the vendor finance, they get their money plus they get their interest, and what's left over is your profit at the other end. They still need security. The original owner this security could come by way of a mortgage or a second mortgage, or it could even be some other security that you have outside of that.
So that's what I was meaning, though. If they have a mortgage over it, then does the finance...
That's a second.
Oh, just they have a second. Okay.
Well, they have a second after the first
Yep.
mortgagee comes in.
So would you structure that as... I'm sorry for throwing curveballs at you because this is interesting and people listening might be the same. But I'm thinking vendor finance is going to happen before you go for any commercial finance. So would you structure that the first person getting the mortgage is actually getting a second mortgage? Or does it just change at the time?
So, more often than not, you'd register the second straight after the first. You don't normally you can't register a second and then register a first.
Yeah, that was my question.
Yeah,
okay.
the second would come later.
Yeah.
Look, they're good. I haven't done lots of them.
It'd be hard, wouldn't they?
They're harder to negotiate. Sometimes it works. Where it really works is if the person selling the land, ideally if their land's unencumbered, because, like, let's say they had 50% debt on the land. Well, that's not going to work because if you buy it for 50%, it only pays out their debt, gives them no money at all. So ideally it needs to be unencumbered with no debt, and it also needs that they don't need all the money now. And they're happy to get the rest of the money later and an interest rate return on that money. The thing is this, that with the vendor finance deal, the title changes. So it goes from them. So they get half the money, but they're giving away all the land. They have security and a loan document and all that. If you go back to the other one, the equity partner, let's say the equity partner, well, that investor's part of the deal. The loan partner, they got security and they're getting an interest rate. So that's a bit easier to negotiate. And there's other types that we don't even have time for in this podcast, like joint ventures with landowners, once again. They're an easier type of deal to negotiate. The most common creative strategy that we have, and you know this very well, is either one of the equity partner or the loan partner. That's the most common one of all. They're the easiest thing to do, easiest to negotiate. Both parties get a great outcome, good security.
Pretty stock standard. Yeah. Okay, Bob, the next one then is Mezzanine Finance. So using secondary loan to cover gaps in funding. How does Mezzanine Finance, I've gone straight to the short version, but how does that work and why would people want to use Mezzanine Finance?
Yes, look, it's not something people usually do when they're starting off, and it's often on larger projects, but technically it could be on smaller projects. How it works, there's a thing called the property stack. And if you think of a normal property development where you put in some equity, the financier puts in the debt, well, that's a stack of two, equity and debt. That's what it is. The equity might be 25%, the debt might be 75%. That's the stack. Now, let's say that 25% that you have to put in, what if, and look, it could be the same financier, but it could be another one as well. Let's say they were willing to put in 15% and you put in 10 to make up that 25%. That's called mezzanine finance, that 15 that came from, technically it could be the same financier who's lending you most of the money, or it could be another financier. What it means is that you put in less money. Instead of putting in 25%, you now put in 10%. The other financier puts in the 15 and the original financier puts in the 75. That original financier will want a registered first mortgage over the title. That's their security. The mezzanine financier would get a second mortgage. So they're subordinate, what you call subordinate. They're subordinate to the first mortgagee, which is called senior debt. So you've got senior debt, subordinate debt. The security is first mortgage, second mortgage. Now, the interest rate that mezzanine financier gets obviously is going to be higher than the financier who has the first mortgage because it's a higher level of risk for them. So from your point of view, it'll cost you more in interest for the project, but you're putting in less money. You make a bit less profit because the interest has now gone up, but from your point of view, the return on your capital, if that's what you're looking at, is very high because you're only putting in 10% and you're getting the profit. The profit's reduced a bit by the mezzanine debt, but it's still a huge return on your capital. So it's not often that people just starting out use mezzanine debt. It's a little bit later, a bit more sophisticated, often on larger projects, but could be. But you remember that mezzanine debt could also be from an individual investor. They could, a person could put in that 15%, get a registered second mortgage, get the higher interest rate. It doesn't have to be another lender, although, in bigger projects it is. There's lenders that just specialise in mezzanine. There's some lenders that will lend, first mortgage and second mortgage, senior debt and subordinate debt. But it could just be, when you're starting out in property development on smaller projects, it could be just an investor who tops up your equity. And that would be a loan partner. So we've sort of gone in a circle there.
We have. We haven't really talked about how sometimes Mezz Finance can come in at just any time, and it might mean that people need a top up for some reason, or they're at the end of their deal. They're at the end. Just explain where that might pop work there, Bob.
Well, that's, if we want to stick to our own terminology, we'll move away from Mezz and just call that a loan partner bringing money in on a second mortgage security.
There you go.
That's how we talk. That could happen right at the very beginning.
Yeah.
It could happen at the construction phase, or it could happen even at the end. Let's say a developer is close to finishing. They've had some cost overruns, things have happened, it's taken longer to build, and they're running out of loan funds. And they're going to be $100,000 short to pay the builder the final money. Well, that's very close to the end of the project. That's when an investor could come in and lend that $100,000 at that point. I know you've done that for somebody as well. Very close to the end of a project. So that's other money, that subordinate debt, that mezzanine debt, that loan partner's money, whatever you want to call it, it can come in at different stages of the project.
And you've got to remember, when a project's at that stage, even if it's second mortgage, the security's not as high as first mortgage, it was profitable to start with by a huge amount, which means that it's very secure. Like that's a very secure second mortgage, isn't it?
Particularly at the end.
Yes.
Where you're only maybe 1 or 2 months off completing the construction.
And if the developer needed to refinance to top up that money, it can often just cost them too much in fees and time. Hey, so it's just easier sometimes to get somebody outside, which was the reason I stepped in.
Yeah, and the first mortgagee might not want to extend their loan. So you've got to get the money from somewhere to finish to pay the bill, and that's just a bit of some private funds, really.
And again, it's so
safe.
normal. You might be listening to it and thinking, I don't know what you're thinking, but it's just so normal in our community and in our world. It's so normal, isn't it?
It is very normal, yeah. That's a short-term loan, might be 4 months, 5 months, 6 months.
In fact, I sent out an email for those of you that are interested in investing. Ultra Urban, we've finally kicked off the website, ultraurban.com.au. So we've separated property mastermind education to the developments that we do in investments that people can invest in. So if you're interested in investing with us, check out Ultra Urban, ULTRAURBAN, ultraurban.com.au. If you're interested in investing in projects that we have, we've currently got a few underway, but we've got a couple of mentoring students who are looking for short-term funds. So if you want to pop in on those and check out what they are, jump on the website and send me an email through there. And you might be interested in joining something with the Mezz Finance. It's just exactly what we're talking about. Yeah, good timing. But anyway, we've launched it and we're excited to separate it and get that underway. So Bob, thank you. What about... Let's just talk about pre-sales and off-the-plan sales. What's the impact on those with finance?
Well, probably nothing.
Okay.
If we're going to use a non-bank. Banks traditionally are more conservative, and they like to cover what you call their exit strategy at the other end. So before they lend you construction finance, they might want some off-plan sales, particularly on slightly larger projects. The bottom line is you're probably not going to be getting your finance off a bank these days. It's going to be a non-bank. And they don't need pre-sales, so it's not really a benefit. You might want to get a couple yourself, but
just for peace of mind.
Well, if you want to, yeah. But no, typically, if you don't need them, it's always easy. It's always easy to sell a project. Well, the easiest time to sell a project is after you've finished it, when it's completely finished. That's the easiest type of sale. When you're getting close to completion, it gets not quite as easy. Selling before you even start is harder.
Why is that?
Well, is a project even going to go ahead? We've seen projects, like big ones. Remember the big one not far from where we live, where
they
had to get a certain number of pre-sales, and it was a lot because it was a big project. before they could get the money from the financier to do the project, they didn't get enough pre-sales. The whole project never went ahead.
It was huge, a massive, like, sky rise with, they built the whole, what do you call that? The demonstration area.
Yeah, big
it was
display suite. They must have spent $500,000 on that.
It was beautiful, and it was really exciting, really. And then nothing happened.
Well, they didn't get enough pre-sales.
They painted the whole thing orange, and it just turned into an orange elephant. It looks terrible.
Yeah. So typically the sort of projects that people are doing in our community, they're going to be non-bank.
Yep.
And you're not going to have to worry about pre-sales. So.
Well, Bob, I think we could almost wrap it up, but I think it's time for me to let everybody know that we have an event coming up, and that's on the 3rd of June. So that's one of our free lunchtime events, and it's going to be a how to finance your project. So Bob runs through 45 minutes in your lunch break on the 3rd of June. It's a Tuesday, I think we run these. And you might want to register for that. So if you want to, just there'll be a link below this podcast. You'll be able to register for it. And the goal is to just educate you on how to finance your project, maybe take you through this in a more detailed manner so you feel a lot more comfortable about financing projects. Also remember, we do have our online course, our bundle available, which is the full online Property Mastermind property development course. We teach thousands of people, Bob has, and he's been doing developments for over 40 years. Most people are just people like you and I doing all sorts of developments, or first timers, and people like Carla doing her first little subby, and we had live Q&A last night. Someone else has found a little subby in Brisbane. So it's exciting times, and there's plenty happening. So if you're interested in property development education, jump on over to our website, propertymastermind.com.au. There'll be a link below for that as well. And you're welcome to have a chat to me if you're interested in maybe moving forward and getting us to help you in bigger ways. But Bob, I think we've done a great job on creative strategies.
Thanks. I think so.
You did a great job. I just kind of sat here. Take 2 was better than take 1.
Take 2, much better.
Yeah, I think, it was a bit more exciting. Take 1 was really naff, I think. No, it wasn't.
No, it was good.
It was pretty good. All right, well, we hope that for those of you in Southeast Queensland that you get through the next few days. We wish everybody luck, and we're amongst you as well. So thank you to people in our community that are sending text messages and asking if we're okay. We really appreciate it. It's so kind, and we hope you're okay too. All right, well, that's the end of this week's episode. Catch you next week.
Bye.
Bye.